Okay, so morning everyone. I think it's time to get started. Welcome to our last session of ABFER investment. We are talking about the new perspectives in investing. And of course, this session is a little bit far away from the other two, but nonetheless, we have 4 excellent papers to talk about. Okay, we already have the preventing time convention posted in the chat. Presenters have 20 minutes, then discussants have 15 minutes, and 10 minutes for Q&A. And please either type your questions in the chat window, or you can just, for the panelists, you can just unmute your Zoom and directly raise questions. Okay. Our first paper is Taming the Bias Zoo, and Cameron Peng from London School of Economics is going to present the paper. So Cameron, it's your time, and you have 20 minutes. I will remind about the 5 minutes before the end. Thank you.
Great. Thanks a lot for, first of all, many thanks to the organizers for putting this paper on the program. This is a joint work with Hongqi from CUHK Shenzhen. We have 2 Wei Xiong on the paper, one from Shenzhen Stock Exchange and the other from Princeton. Over the last few decades, the behavioral finance literature has made significant advancement by bringing sharp insights from the psychology literature to explain a wide range of anomalies in financial markets. A byproduct, however, is that we often have multiple behavioral biases for each single anomaly. And now we're concluded with a large set of behavioral biases explaining a large set of facts, and this is not completely satisfying. First of all, it is unlikely that all of these biases are going to be equally important. Secondly, it is also quite possible that certain biases will be subsumed by others once we put all of these biases in the same framework. To eventually arrive at a unified conceptual framework, it is therefore quite important for us to consolidate the multiple explanations for each anomaly. To give an example, consider the excessive trading puzzle, which says that retail investors appear to be trading too much. There are several layers to this puzzle. Before fees, investors are already making a return that is lower than the market return. Second, transaction cost is going to make their performance even worse. And third, in the cross-section of individuals, those who trade more tend to perform worse. Now, this is a fairly robust empirical finding. As a result, many behavioral explanations have been proposed on top of various rational explanations. So the behavioral explanations, for example, include overconfidence, realization utility, gambling preference, sensation seeking, social interaction, etc., you name it. Facing this myriad of explanations, we really need to narrow down to the few that are most important. The task of consolidation, however, is fairly challenging because many existing explanations by design share similar predictions on the target anomaly. While some of them may offer slightly different predictions on more subtle dimensions, the power is often constrained by the availability of observational data. And it's even harder to run horse races among multiple explanations because, as we know, constructing one imperial proxy for one explanation is often quite difficult already. As a result of this challenge, the recent literature has turned to survey-based approaches by eliciting investors' own perspectives on their investment decisions. A key advantage of this survey-based approach is that it allows us to collect information from many mechanisms fairly quickly and therefore permits horse races among different explanations. However, there are also widely held concerns about the use of surveys in economic analysis. For example, respondents may not truthfully report their answers, and even if they do, their survey responses may not really translate into real actions. Moreover, when we're trying to rank among different explanations, some sort of question-specific bias may distort the relative ranking among these different kind of explanations. And this is precisely where this paper is coming from. We adopt a new approach to consolidate this bias zoo, specifically by combining surveys with transactions. In doing so, we overcome the challenges faced by these existing approaches. Now, in this paper, I'm going to illustrate this approach using this excessive trading puzzle as an example. We conducted a nationwide survey among Chinese retail investors. Our data cover more than 10,000 individuals that are randomized across provinces, brokerages, and branches. And we design our questions to measure an exhaustive list of trading motives. What's quite unique about our setting is that we're able to merge server responses with account-level transaction data at the Shenzhen Stock Exchange. This allows us to demonstrate that server responses are largely consistent with the trading behaviors they are designed to capture. As an example, investors who report to have a gambling preference according to the survey do tend to buy lottery-like stocks in their transactions. And this kind of consistency result is going to provide further justification to the use of surveys in our analysis. After this kind of validation, we're going to conduct two sets of exercises. First, we run a horse race among survey-based measures of trading motives to see which ones seem to be the most relevant for excessive trading. Second, we do a comparison between survey-based and transaction-based measures. And here is what we find. In our first set of exercise, we have four main findings. First, in the horse race, two trading motives stand out: gambling preference and perceived information advantage. So in our sample, the standard deviation of monthly turnover is about 126%. Gambling preference can explain up to 21%, and perceived information advantage can explain about 24%. Second, we show additional evidence to further support these two trading motives. For gambling preference, we find that these gamblers tend to trade smaller, high beta, more volatile, and more positively skewed stocks. For information advantage, we find that these people who claim to have information advantage do not actually deliver better returns, which suggests that these investors are overconfident about having an information advantage. Third, indeed, we find that in the horse race, some explanations are subsumed by others. For example, although sensation seeking is fairly significant in univariate regressions, it is no longer so in multivariate regressions. Finally, for a given bias, but one with different multiple forms, these different forms don't really have the same kind of explanatory power. For example, out of the three forms of overconfidence we consider, overconfidence about having an information advantage works very well in explaining excessive trading, whereas miscalibration of uncertainty, which is another form of overconfidence, works rather poorly. Now, in our second exercise, as I mentioned, we're going to compare survey-based versus transaction-based measure. And here I'm going to use gambling preference as an example. So to make this comparison possible, we're going to first construct alternative measure for gambling preference instead based on transactions. And we're going to call this gambling behavior. And this is measured by an investor's propensity to buy lottery-like stocks. It turns out this gambling behavior measure is more powerful explaining turnover. However, it is not only correlated with gambling preference as it is designed to be, but it is also correlated with other trading motives. This result highlights a trade-off between survey-based and transaction-based approaches. On the one hand, the survey-based approach allows us to construct direct measures for each trading motive and therefore allows for horse races. However, for each one of these trading motives is going to be subject to measurement noise at the individual level and therefore less powerful. On the other hand, the transaction-based measure may be more powerful in explaining turnover or the target anomaly, but the transaction-based measure may simultaneously capture multiple trading motives and therefore less reliable in isolating a single mechanism. Now, moving on to the main part of the paper, let me tell you a little bit more about the survey. So we conduct our survey through the Investor Education Center at the Shenzhen Stock Exchange. The survey took place about 3 years ago. We randomized across the branches of China's 10 largest brokers, 500 branches in total, each with a target size of 20 investors. To boost response rate, we put up the logos of the exchange, as well as the Finance Institute in Shenzhen. We included confidentiality agreement, as well as monetary rewards. Now, the main part of the survey has 4 parts. It starts with the financial literacy survey, then moving on to survey investors' trading motives, which is the core of the survey. At the end, it has a part about demographics as well as a nudge experiment. So I'm not going to talk about the nudge experiment today. It's going to be included in the paper. Now, let me tell you a little bit more about part 2, which is the core of part of the paper. So here is where we survey investors about their trading motives. For each trading motive, we phrase the questions to map as close as possible to the underlying concept. And we do so by often going back to the original paper proposing that particular motive. Notice that a motive may have different forms of representation. And in such cases, we include at least one question for each trading motive. Furthermore, to ensure the quality of survey responses, we design all questions to be multiple choice. So most of our questions are qualitative, and they fall into 2 types, statement type or frequency. For statement type of questions, the answer options range from strongly agree to strongly disagree. For frequency type of questions, the answer options range from always to never. In some cases, we also try to elicit some quantitative answers, and here, each answer option covers a fixed range of value. Finally, to facilitate a horse race, we encode all of these survey-based trading motives into dummy variables so that we can have an apples-to-apples comparison. Here is a very brief overview of all the survey-based trading motives we consider in this paper. For example, for overconfidence, we consider overplacement as well as miscalculation of uncertainty. For neglect of trading costs, we consider 3 different forms. One is about underestimation of transaction fee. One is about the frequency of considering cost. One is about the lack of consideration for the beta spread. For gambling preference, we have 2 versions, one with, one without probability weighting. For sensation seeking, one is about novelty, the other is about volatility. For realization utility, we consider 2 scenarios, one about winners, the other about losers. For extrapolation, we consider 2 kind of trends, one upward trend, one downward trend. For information, we consider 2 scenarios. One is about overconfidence of one's own information. The other is about dismissiveness of others' information. For each social interaction, we consider family and friends, as well as investment advisors. And finally, we also include a bunch of classic kind of like trading motives, liquidity needs, portfolio rebalancing needs, etc., etc. So the bottom line here is that we try our best to have as comprehensive as possible a set of trading motives in designing the survey. So our survey sample is around 30,000 investors. We drop observations who spend very little time on the survey, which reduces our sample size to around 11,000. So here on the left-hand side, we compare the demographics of the sample to that of the population. As you can see, our sample is a bit more balanced in terms of gender, is a bit more well-educated as well, and slightly younger in terms of age. On the right-hand side, I only show you the distribution of income and wealth for our investors. We don't really have the national average distribution for comparison, but I can safely tell you that we're looking at a relatively well-educated, wealthy sample of investors. Now that I've collected all these survey responses, what I need to do is to merge these survey responses with trading data. So we're going to use these 4 demographic variables: name, date of birth, broker name, and branch name. And these 4 demographic variables will allow us to uniquely identify a substantial set of investors at a centralized database in the Shenzhen Stock Exchange. We further require investor to have a positive stock holding in the 2-year window before the survey, and this is going to reduce our sample size to around 4,600. Now here in the 2 tables below, I give you the summary statistics of these sample of investors in the post-survey period, that is the 9-month window after we conducted the survey. As you can see here on the left-hand side, these investors do trade quite a bit. The average turnover at a monthly level is around 100%, and the standard deviation is about 126%. They also perform rather poorly. So during this period of time, the market actually went up a few percentage points, but the average raw return is slightly below 0, but the net return is around 30 basis points on a monthly level. On the right-hand side, we further show the correlation between turnover and performance. So if you look at here, even before transaction fees are considered, we're looking at a negative correlation between returns and turnover. And if you include transaction fees, that is going to make this negative correlation even stronger. So as we expect, the excessive trading puzzle pretty much holds in the Chinese sample as well.
5 minutes left.
Great. Now that I've merged these two data sets, what I'm going to do is I'm going to do a validation test to show that these server responses indeed capture the trading behaviors they are designed to capture. So we have more validation exercise included in the paper, but here in the presentation, I'm just going to talk about gambling preference. To validate gambling preference, I'm going to first construct a measure called gambling behavior that is solely based on transactions. And this is measured as the tendency to buy lottery-like stocks. As you can see here, there is a fairly positive and statistically significant correlation between gambling preference and gambling behavior, and this result is fairly robust to alternative specifications. But the R-square here is fairly small, which I will come back to. The other validation tests include things like extrapolation, risk aversion, return expectation, and all of these results are consistent. So what I've done so far is that I've validated that indeed these server responses can reflect actual trading behavior. Now I'm going to use these server responses to run a horse race. I'm going to run a horse race in 2 steps. In the first step, I'm going to run a series of univariate regressions by regressing turnover on each one of these trading motives alone. And all of the coefficients will be included here in the first column. In the second step, I'm going to pull all of these trading motives together and run one multivariate regressions, and all the coefficients will be reported in the second column. Comparing across these 2 columns highlights 3 main findings, and I have highlighted them in 3 different colors. Let's start with the blue ones. Gambling preference here, as well as perceived information advantage here. So these are the true trading motives that stand out, not only in univariate regressions, but also in multivariate regressions. And I'm going to provide some further evidence on these 2 mechanisms. Let's move on to the green color. So sensation-seeking novelty and sensation-seeking volatility are the 2 trading motives that turn from significant and positive in univariate regressions to insignificant in multivariate regressions. Finally, the 3 trading motives that are colored in yellow are the ones that seem to be insignificant or negative, but seem a bit inconsistent with existing theories of trading motives, things like underestimation of transaction cost and social interactions. Now I'm going to zoom into these 2 trading motives and provide more evidence. For gambling preference, I'm going to provide further evidence in 2 ways. First, instead of coding this variable into dummies, I'm going to have a finer sorting by sorting investors into 5 groups based on their answers to this gambling preference question. Across the 5 groups, you see this monotonic increase in trading volume, not only in terms of means and medians, but also in other distribution. And the difference is around 20% in a monthly level, which implies a 0.6% transaction fee. These investors who trade more and more prone to gambling do not seem to be delivering better returns, as shown in panel B here, which suggests that their behavior is not completely rational. We repeat this same exercise for the question about perceived information advantage, and we find very similar results here. Again, those people who perceive themselves to be better traders and know the stocks better do not actually deliver better returns, suggesting that these investors are overconfident about having an information advantage. Now, so far, we've kind of highlighted these 2 trading motives in our horse race. But there is one lingering concern. That is, it seems that survey responses could be quite noisy. Indeed, the R-square here is quite small when you calculate the correlation between gambling behavior and gambling preference. One appeal of survey-based approach is that, we can, compare many things, at the same time. But what if we can actually construct a transaction-based measure? It turns out once we sort on gambling behavior measure, this gambling behavior measure is actually more powerful in explaining turnover. But there is actually one problem. That is, if we regress gambling behavior on a variety of survey-based measures, it is not only correlated with the designed sort of like gambling preference, which it is designed to capture, but also correlated with other trading motives. This suggests that it might not be able to reliably isolate in a single mechanism.
1 minute.
So to conclude, great, I think I'm right on time then. So this is what we do in this paper. We study why retail investors trade so much with a new approach by combining surveys with transactions. In our first validation test, we show that server responses can actually capture trading behavior in significant ways, and we do so by merging survey data with transaction data. We further do this kind of taming the behavioral bias zoo exercise by sort of distilling to do behavioral biases that seem to be the most relevant in explaining excessive trading. And we've narrowed down to overconfidence about one's information, as well as gambling preference. We also show, for example, some popular arguments, such as neglect of trading costs, low financial literacy, and social influence do not explain volume, at least on our setting. Finally, we have this comparison between survey-based and transaction-based approaches, and we've listed their pros and cons. Thanks a lot for this opportunity, and we look forward to the discussion as well as the feedback. Thanks.
Thank you very much. Our discussant is Weikai Li from Singapore Management University. For the rest of the audience, please feel free to type your questions in the discussion board.
Okay.
50 minutes.
Okay. Can you see my slides?
Yes. Yes.
Okay, great. Thanks. I want to thank the organizer to invite me to discuss this very interesting paper. And so I think Cameron did a very good job in terms of presenting the paper. So I will just quickly summarize the main idea of this paper. So the main idea of this paper is to use a survey-based approach to elicit various trading motives of retail investors in China. But they don't stop there, as the current studies did. They combined with the transaction level data and to evaluate the importance of these self-reported motives in explaining the actual trading behavior. So the main finding is that first, it validates that the survey-based measures of investor bias do capture what they intend to measure. So it's a good validation test. And then they identify two investor trading motives that are most important in driving the actual trading. These are gambling preference, the preference for lottery type of assets, and also perceived information advantage. And they further show that these two motives actually are not ranked very high based on survey response. So it highlights the novelty of their approach. And finally, they also present some evidence showing that the transaction-based measure of trading motive, although has more eccentric power, but may suffer from some issues, which is capturing multiple trading motives. So I think this is a very thoughtful and carefully executed paper. And in particular, I find three particularly important insights. First is that I think they start from the paper with a very insightful discussion of the various pros and cons in the pure observational-based approach and the survey-based studies. And then they highlight the novelty of their approach, that by combining the strengths of survey and observational data, they allow researchers to measure the specific trading motive closely to conceptual definition. And also, combining with the observational data can mitigate potential distortion due to bias introduced in the survey. And also, I found that they designed the survey questions very carefully, and these are all motivated by the existing literature on behavioral bias. And the questions are also intuitive to understand even for a layperson. So in my view, I think the most important contribution of the study is actually methodological, irrespective of the particular results they get from this study. So to understand the contribution of this methodological novel methodology, we need to start from the beginning. That is why the survey-based approach is not often, it's actually very rarely used in economic research. And this may partially attribute to Milton Friedman, famous methodological argument that economic research does not need to rely on the assumptions to being realistic. Because as he argues, the only relevant test of the validity of a hypothesis is a comparison of its prediction with real experience. The hypothesis is rejected if its predictions are contradicted. It is accepted if the predictions are not contradicted. So all that matters is whether or not a model fits the data, and the realism of the assumptions are totally irrelevant, according to Milton Friedman's argument. So particularly in that famous methodological paper, he argues that survey-based approach is actually not very useful. So there I just quote him in the following paragraph. Questionnaire studies of businessmen's and others' motives or beliefs about the force affecting their behavior seem to me almost entirely useless as a means of testing the validity of economic hypotheses. So, of course, many economists disagree. So Paul Samuelson says this is term this as F-twist. And we know that if the only agenda objective to evaluate a model is to see its prediction and whether it fits with data, then it can lead to many issues. So the theories can be reverse engineered to fit the data, and also can lead to p-hacking, factor zoo, bias zoo, as we see in both asset pricing and in other disciplines. So that's why more and more recent studies start to take a survey-based approach. So the survey-based approach can either be used to test competing theories that make observationally similar predictions, or to build models based on more realistic assumptions. And these assumptions often motivated by survey-based evidence. So in corporate finance, we have Graham and Harvey survey, which actually motivate a lot of corporate finance studies. And in asset pricing, we have studies, including this paper, that use survey-based approach to evaluate asset pricing models. However, this paper is actually go one step further. They don't just stop at a survey. They actually see whether the survey-based trading motive can explain the real data. So they actually address, so go back to the Friedman's question. The only relevant test of validated hypothesis is the comparison with prediction with experience. Actually, so this survey-based approach that I mentioned before this paper, they only look at the survey itself and use the ranking of the survey response to evaluate a particular assumption. However, this paper goes a step further. They actually address Friedman's critique by evaluating the assumptions against the prediction and also confronted with the real data. So actually, it's one step further above the existing survey-based study. That's why the paper is so novel and not surprising that it's already forthcoming in JFE. So I have three main comments. I think the paper is already well executed and have full set of results that are very insightful. And so my main comments are mainly on three perspectives. The first is on conditional prediction versus conditional prediction. And the second is there may be some confounding effects from heterogeneous information flow. And the third comment is that the survey questions, if not designed well, may still elicit multiple trading motives. So I will focus on the comments one by one. So my first comment is that behavioral finance theories actually predict for certain trading motives, they only lead to excessive trading conditioned on external stimulus, information release, or market states. So for example, Friedman found that salience of purchase price can amplify the disposition effect. And Liu et al. Found that preference for lottery assets, the gambling preference, is more pronounced prior to earnings announcement. And I have a recent paper shows that even extrapolation is more pronounced prior to earnings announcement. And also it's well known that investors exhibit great overconfidence and hence more trading volume in a rising market compared to a down market. They could possibly due to self-attribution bias and biased learning. So for some results in the paper, they also did not find a significant relation between a trading motive and the actual trading behavior. However, the regression is unconditional, so it may actually underestimate its importance. So, for example, social interaction is a recently proposed important behavioral bias that can lead to more trading, but also actually did not find a significant effect on the social interaction dimension. However, we know that social interaction may actually lead to more trading only when the market is going up. and when people are making money, this is because the natural tendency for people to maintain their self-esteem, and they're more willing to share stories about their gains rather than losses. So I understand that in this sample of the survey, this is actually a normal period without a significant market bubble or burst. However, it's still possible to do some conditional tests based on the cross-section of stocks or sectors or styles. So for example, you can test this idea using subsample stocks that performed very well during your sample. So if you find such a subsample stock, you may find some significant relation between a specific trading motive and actual trading, even though in the full sample, you find an insignificant relation. And why this is important? Because the bubble is actually a very fascinating phenomenon. So the behavior, investor behavior during the bubble period is actually maybe more informative for behavioral finance theory than the normal periods. So that's my first comment that tests further the conditional prediction made by this behavioral finance theory. The second, my main comment is that there's maybe some confounding effects from heterogeneous information flow across stocks. So the current specification of this paper is a pure cross-sectional regression of investor level turnover on survey-based trading motive. So this is their main regression specification. So the I here indicates the investor, and each X represents one particular trading motive. However, we know that information arrival, news arrival can affect trading. So things like earnings announcement, analyst forecast, news, and rumor can affect investor trading activity. And one problem of this specification is that investors with different trading motive may actually self-select into different type of stocks with heterogeneous information flow. And it's actually the heterogeneous information flow that drive the trading, not that particular trading motive. So for example, overconfident investor may mainly trade in small growth stock, while less overconfident investor may trade in blue chip stocks. And we know that these type of two stocks have different frequency of information release. And that may correlate with your outcome variable, the actual trading activity. So what is the ideal experiment to test whether investor behavioral bias can actually drive trading? So in my view, the ideal experiment is to compare two investors with different trading motive, but trading on the same stock at the same time. So by this way, you can control for any information effects and then isolate the investor particular trading motive in driving the trading. So this is possible to do for trading activity because trading is actually at the individual investor level. It's maybe more difficult to do this to test the equilibrium outcome like price, where you only have one price for one stock. But at least for the trading activity, I think it's conceptually possible to do so. So for example, if you have a richer data set, you can measure turnover at the investor stock time level and control for stock by time fixed effect. Although I understand this may be too infeasible given the current data limitation. So one suggestion is that you may measure the turnover at the investor stock category level and then control for category fixed effect. The reason is because in China, there are different type of industry and style or even the listing market can affect the stocks in that particular category very differently. So stocks listed in mainboard, SME, or G-Next have very different investor clientele, so may attract a different type of investor. And also the stock characteristics of these stocks listed in these different markets are quite different. So it's possible to control for a less restricting set of fixed effect, but still possible to control for some type of heterogeneous information flow. So my last main comment is that some survey questions may still elicit a multiple trading motive, despite your best effort and the intention to isolate one particular motive. So you argue that the key advantage of survey-based approach is that allow you to isolate a specific trading motive more cleanly than transaction-based approach, because transaction-based approach can capture multiple mechanisms. And however, this assertion crucially depends on how you design the survey questions. So some survey questions may implicitly elicit a multiple trading motive, despite your best effort and intention. So for example, the following questions depend on how you interpret the question. It can actually elicit a multiple trading motive, at least from my point of view. So the question is following. When I trade stocks, I aim to select those stocks whose price would rise sharply in a short period of time so that I can make a lot of money quickly. So you use this question to elicit the gambling preference, but it may also implicitly measure investor overconfidence in being able to select such blockbuster stocks. If I don't think I'm able to select such stock, I wouldn't even think about these questions in the first place. So this question may elicit overconfidence in addition to gambling preference. So I want to see more evidence to support this argument that survey-based approach can indeed isolate a specific trading motive more clearly than the transaction-based approach. So actually, you can follow the test in your table 14. So currently, you argue that the transaction-based approach is not satisfactory because it can capture multiple trading motives. And this is evidence. So you see that the transaction-based gambling behavior correlate with not only with gambling preference, but also with other behavioral bias, such as perceived information advantage. So my question is that what if you do the same test for the survey-based gambling preference? What if you use the survey-based gambling preference as a dependent variable and see whether it's less or uncorrelated with other survey-based trading motive? So this to me would be a more apples-to-apple comparison. And then if you indeed find that the survey-based gambling preference is not correlated with other survey-based trading motive, then the argument would be much more convincing. So I have a couple minor comments. The first minor comment is that
1 minute.
Okay, I will quickly talk about these comments. First comment is that I find investor attention is not listed as one trading motive in your paper. And in fact, the measure you use for gambling behavior, which is price limit in China, can also capture investor attention. So there are some papers use this measure to capture investor attention. And also you talk about over extrapolation, but I think you only consider return extrapolation while ignoring the fundamental extrapolation. The idea is that investors not only extrapolate the return, past return, but also past the cash flow news. And this is a very prominent idea, although empirical evidence is not as comprehensive as the return extrapolation. I think it's worth considering. And finally, it's a bit puzzling to me that the coefficients on the social influence, social interaction are actually significantly negative in univariate regression. I think some explanation may be needed here. So overall, I think this is a great paper, a very novel paper that combines the best of the survey approach with the transaction data. And I think this approach can be useful to apply to other settings where the same research question or research facts can be explained by multiple explanations. And my two comments are that test models that make a conditional prediction about the trading activity and also disentangle the effect of trading motive from heterogeneity in stocks information flow. So that's all my discussion. Thank you.
Thank you very much. Cameron, you want to respond?
Sure. First of all, thanks, Frank, for the very thoughtful discussion. Especially, I apologize that by the time you did your discussion, the paper is already forthcoming. But rest assured that we will take actually all of these comments very. They will be of great use. I think we're doing a follow-up project as well. We'll definitely incorporate a lot of the very, very useful feedback into the next design of the survey. As you said, this is one of the first exercises that we did to actually combine survey with transactions, though, there's a lot to learn, but thanks a lot for the comments. Just some quick responses about the 3 points you just brought up. The first point is very well taken about the conditional versus unconditional. It's a caveat that we definitely have taken into account. Perhaps even in the later revised draft, we've tried very careful to say that this is very much, we're looking at a very stable period. A lot of the perhaps theories are inherently conditional, for example, conditional on a booming period or a bust period. We won't be able to test those theories. Your suggestion is very well taken. Perhaps we should have explored a little bit more cross-sectional variation at stock level. Perhaps there are some sort of stock level boom and bust period that we could have exploited to further test this, but that's a very good suggestion. So, I myself have a paper on sort of bubble and crush and about trading volume. I'm very sympathetic to what you just said. The second comment about using perhaps using some sort of there's this alternative explanation going on. I mean, I think I wasn't able to sort of fully digest the comment. Maybe I will need to think about it a little bit more. But perhaps this kind of matching between investor characteristics, trading motives with stock characteristics is actually something that we do want to capture. You know, overconfident investors may trade growth and stocks. Maybe this is actually what drives them to trade a little bit more. I'm still a little bit unsure about whether this is actually a problem or a feature of our design. So I'll have to think a little bit more. So relatedly, I'm not sure if if we're actually looking at the stock level would actually help us pin down. My intuition is that it actually is kind of in line with what we're saying, but we can talk a little bit more about this offline. The last point about potentially one question is sort of capturing different motives. We are fully aware of those. I mean, we tried our best to obviously try to tailor the question as closely as possible to sort of the textbook definitions, but obviously, it's not, perhaps even different people have different definitions of what, overconfidence means and what, for example, gambling preference means. The specific question actually you brought up about, for example, if there is a correlation between overconfidence and the question, we actually tested those. We actually, for example, the question you have in mind here, we've designed like 3 different versions of overconfidence. And I think in one of the tables we actually have in the paper, we do report the correlation coefficients. And I think here is actually, if they're actually either weakly correlated or even there is no correlation at all. And I think, for example, for overconfidence and versus gambling preference, we find that they're kind of almost like independent traits. So if you believe that what we have designed, I think we're actually very confident about the measures of overconfidence because these are very well used in the literature. Maybe we're overconfident about overconfidence, but we are actually fairly. I think the point is well taken, but. And I think we have some answers in the paper about this last point. But thanks a lot for the thoughtful discussion. You've obviously put in a lot of effort, so we really appreciate that.
Thank you. So now we are opening the discussion to the floor. Anyone have any questions? Please either type or directly unmute your Zoom and directly raise questions.
So I see a question in the chat. Perhaps I can just take a look at that.
Oh, yeah. Sure.
BGS proposed diagnostic expectations. I interpret this overwhelming attention-grabbing new information as underlying theoretical explanation for much of the bias. Do your result reconcile with the approach for suggesting a different correction for theoretical consolidation? I think, if I understand correctly, I think the Schleifer diagnostic expectations paper is primarily about microfounding extrapolation, whether it is extrapolation through fundamentals, what Frank just said, or extrapolation through return extrapolation. So I think it's a very well microfounding model for overreaction. In particular, it's about belief formation. In our paper, is actually we did not find much of a role for beliefs. And I think it's reasonable because if you want people to trade using beliefs, you would need their beliefs to waver over time, to change over time. But our setting is inherently a cross-sectional setting. So, it's we have a cross-sectional setting, but I think if you want to use beliefs to explain people's trading behavior, why people trade so much, you would need their expectations to actually change a lot over time, which we would not be able to capture using one cross-section. So no, we don't really kind of speak to that particular phenomenon, but I think you are looking at very different kind of, perhaps slightly different spectrum in terms of the research question. I think we are really targeting at excessive trading. I think for Andre's paper is primarily probably more about belief formation and how people overreact to information. To what extent does that explain, for example, excessive trading? I'm not sure if there is any kind of evidence there. But we do have some evidence about the relationship between extrapolation and excessive trading. If you think of extrapolation as one form of diagnostic expectations, in our paper, we don't really find there is a very strong explanation. But as Frank said, it could be very much a conditional statement. That is, on a rising market, extrapolation, for example, combined with realization utility or disposition effect, could actually lead to very much trading volume.
So you're only taming part of the bias zoo then?
Yes, we are. I mean, I think we come up with a catchy title, but obviously I think we read the paper with a lot of caveats about what we're doing. We are doing one cross-section, we're looking at one particular puzzle, but we hope this will be a starting point of more efforts on this. That's sort of the where we stand.
Okay, well, it's a good start. Thank you very much.
Thank you.
Okay, thank you for the presentation and discussion and question.